Kevin Warsh was right. The minutes do suggest there was a bit of an old-fashioned family fight at the July meeting as participants argued over the outlook for inflation and monetary policy. Two lines of general agreement stand out. Many participants assessed that policy tightening would likely be necessary if inflation did not decline. Now, remember, this meeting took place after the June CPI report that showed inflation had declined more than anticipated. And participants judged that their inflation outlooks were highly uncertain and that inflation risks were skewed to the upside. Many participants noted that the recent re-escalation of the conflict in the Middle East significantly clouded the inflation outlook. Inflation was first and foremost in the debate, and the committee's counting words show a lot of division. Several participants noted that price increases over the past year were broad-based, and some said underlying inflation appeared to be elevated. AI spending had also been subject to price pressures. But inflation expectations remained contained, and most participants anticipated inflation would step down over the rest of the year as the effects of tariffs and earlier energy price increases wane. But again, many participants noted the possibility that inflation might be more persistently elevated. Several noted companies had accommodated price increases by compressing margins, but they suggested if the Middle East conflict went on, they might have to raise prices, while a couple noted that business contacts judged consumers would resist those price increases. They also disagreed on the impact of AI at the moment, with some noting its inflation risks in the short run, while some also said AI productivity increases would cancel that out. In the end, most members agreed to hold rates at that meeting under the assumption that additional data before September would offer more clarity. And speaking of additional meetings, Chairman Warsh suggested 6 scheduled meetings per year to the committee, held roughly every 2 months, saying that would allow more information to accumulate between meetings and provide policymakers and staff with more time to consider what he called strategic policy issues. Warsh asked for input from the committee, and no decision was reached at the meeting other than there would be no changes made this year.
All right, Michael McKee there at the Federal Reserve. Mike, you're going to stay with us. I'm just looking quickly here in terms of market reaction. A little bit of a lift to the equity trade. I did see the S&P up about 22 points ahead of these Fed minutes. They're now up about 32. The NASDAQ 100 was just down a fraction of a point. Now it's up about 2.5 points. And let's go on over to what we are seeing in terms of U.S. Treasury yields. And we have seen a little bit of a dip lower. So where's that 2-year note right now? 4.18, 5-year note with a yield of 4.35, and you've got that 10-year note with a yield of 4.65. Mike, interesting. First of all, 6 meetings by the FOMC would be 2 less than what's on the calendar currently. What's sticking out here for you following the latest Fed meeting? You were there in the room, put a question to Kevin Warsh, Fed chair, that many thought was really smart in terms of, like, what are you watching to figure out kind of where we go next? But tell us, based off of these minutes, if you got any more clarity about what the FOMC is thinking.
I think what the minutes show is that the committee was much more divided than people had anticipated. The counting words that they use, the adjectives for how many people were on one side or another, are much more in evidence in this set of minutes than I think I've ever seen, and especially the words some and several. Sounds like basically there were people who had opinions on a whole range of things that were expressed, which Warsh said he wants to see, but it didn't suggest at this point that they have any kind of unified view about what's going to happen in the future with inflation. They did say it's very uncertain at this time. My thought was that 3 weeks ago, when this meeting took place, they might have still been leaning towards the idea of a September rate cut. Now we've seen some changes to that view since then in the markets, but this was a somewhat hawkish group of people who were concerned about inflation and the fact that they didn't know what was going to happen.
So, Mike, we're likely to hear from the Fed again in just a week from now at Jackson Hole, now that we've looked through the minutes and we have maybe a little bit more of an understanding of how they're thinking about inflationary pressures and the health of the economy, does it inform us at all about what we're going to hear next week?
I don't really think so because of the stance that Kevin Warsh has taken about not giving any kind of forward guidance. I suspect that he might offer a little bit more in terms of what their framework for monetary policy is, what's their reaction function, and he may outline more about what he's trying to do with his task forces and reforms at the Fed. And then finally, maybe some more comment on how many meetings they might have. But I don't think the markets are going to have a takeaway that the Fed is going to do this or that in the way that they have after some chairman's addresses there.
What's not answered for you, Mike, in these minutes? Like, we always get more detail, right, of what was going on at the meeting. But what is really missing here for you still?
Well, I don't think we get a real clear view of what's going to happen ahead. There was general agreement that if inflation doesn't come down, they might have to raise rates. But there was also general agreement that the inflation picture was extremely cloudy. They said in the minutes that they were hoping the fact that they would have 2 CPI reports, 2 PPI reports, 2 PCE reports before the next meeting would give them more clarity. And I think that's still where we are today.
And Mike, just your reaction today, pivoting away from the FOMC minutes, but on this news of the Treasury and debt buybacks.
It's all kind of related. But I'm just curious, Mike, you know, the Treasury does this, but the size and the timing of it is super interesting.
Yeah, the size is very small compared to the size of the overall Treasury market, and it isn't going to have much of an impact in and of itself. It's more of a signal from the Treasury that they don't like the direction interest rates have been going in, and they might try to convince markets not to push up rates so aggressively. Whether that works or not, we'll have to see. A lot of short covering today, according to the bond strategists I've talked to. But what we're seeing is the Treasury using one of its tools, and that is the maturity curve, to try to control what might happen. Buying more at the short end and buying back fewer at the long end gives some more, buying back more at the long end gives more money into the system so that people can buy more bonds. But the maturity shift does put some risk into what they're doing. What's interesting is also Scott Bessent was very critical of Janet Yellen for doing the same thing when she was Treasury Secretary, and now he finds himself doing it. And I guess the kind of the bottom line here for the Fed is that if you want to bring down lower rates, one good way to do that would be to raise short rates, because then that gives the markets more credibility for the Fed on inflation, and that could bring down the long end.
So do as I do, not as I say? Is that what that is? I don't know. I'm not sure.
Well, you can imagine Kevin Warsh going to the White House and saying, look, I raised rates, but mortgage rates are coming down because the 10-year is lower, so I gave you what you wanted in a different way.